Hi everyone, welcome back to the series of videos on Ind AS, that is Ind AS with Accountsman. So in today's lecture we will be starting with a new standard, that is Ind AS 34, which deals with Interim Financial Reporting. Interim Financial Reporting. So let's get started, and the way we do in every other standard, we'll ask us these questions: what, why, when, how, and as we understand the answer to these questions, what, when, why and how, we'll be done with scope, measurement, recognition, disclosure, presentation and everything of the standard. You get that? So the first question that we have with us is what? What exactly do we mean by interim financial reporting? So the word is interim financial reporting. Financial reporting is a very standard term that we've been using because that's the name of the subject all by itself that we have at this stage. So the focus at the first place, I want you to have it on this word interim. What do you mean by interim? Yeah, interim means anything lesser than 12 months or lesser than financial year. Any period lesser than financial year is interim. It might be quarterly, it might be half yearly, it might be 15 days or it might be 9 months. Anything lesser than the financial year is our interim period. So I'll write here interim period. So the next term that I am trying to make you understand is what do we mean when we use the word interim financial reporting. This means minimum content. What does this mean? Minimum content to be included in financial statements. Now we prepare financial statements for a period lesser than a year, that is for a period lesser than our financial year. What is the minimum content that should be included in such financial statements that are prepared for a period lesser than a year? You get that? So that's the discussion of the word interim financial reporting. Now when you talk about financial statements that is prepared for interim period, that can be categorized into two broad classifications. How many broad classifications? Two broad classifications. First one is complete set. Second one is condensed set. So the financial statements which are prepared for an interim period can either be complete set or it can be condensed set. Now what will happen if it is complete set? What will happen if it is condensed set? Is it or is it both, or have they given circumstances where we need to prepare complete set only, or have they given circumstances where we are given an option to prepare condensed set? Never. It is always given as or. We always have an option to either prepare complete set or condensed set. Standard in no case tells us that you have to prepare complete set here. Standard in no case tells that you have to prepare condensed set here. Standard is wide open with us following either complete set or condensed set. It is left to us. We can choose between complete set or condensed set. Now we'll discuss each of them in detail. What do we mean when we refer to this word condensed set? Condensed set is not new to us. We've already discussed this in Ind AS 1, financial statements preparation. So whatever we have read in IAS 1, that is preparation of financial statements, same thing has to be prepared even now. There is not even an ounce of difference in the way we prepare financial statements under interim stage also when we are preparing complete set. So I'll write it as same as in, okay, I'll write Ind AS 1, N should be a little smaller. Ind AS 1, same as discussed in Ind AS 1, there is not even one line of difference. It will be same to same, no difference. You get that? However, when we say condensed set, see, we are not able to prepare that entire set of financial statements. So we try to prepare something less. That something less is something that should be minimum. I told you there is some minimum content that should be prepared. So what and all should that minimum content include? So there are some specific names given. So I'll tell them for you. Please concentrate. First one, condensed, not milk, balance sheet. We need to prepare a condensed balance sheet. Under IFRS it is called as condensed statement of financial position. Under Ind AS we call it condensed balance sheet. Next one, we need to prepare condensed statement of profit or loss. We need to prepare statement of profit or loss also in the condensed way. Then third one, condensed cash flow statement. We need to prepare a cash flow statement which is in the condensed form. Then we prepare condensed statement showing changes in equity. We have to prepare a statement showing changes in equity in the condensed form. Along with this, we would have to prepare notes to accounts, and we would have to make disclosures regarding significant accounting policies. If there is any significant accounting policies changed, then we need to disclose. Accounting estimates also would come if there is a change. I'll tell that you a little later. So accounting estimate changes will not come all the times because it will be adjusted prospectively. So I'll tell you in detail regarding notes to accounts and then significant accounting policies and impact of that in interim financial reporting little later. So we're still in the first question, what? That will be answered in the question how. Yeah. So notes, significant accounting policies and explanatory statements, or if there is any explanations that is supposed to be given, that should be there. And along with this, certain disclosures are supposed to be made. Certain disclosures are also supposed to be made. So this is the thing that needs to be made under the condensed set. So I'll repeat, under the complete set we straight away go by Ind AS 1 and we follow that. However, under condensed set we have to prepare condensed balance sheet, condensed statement of profit or loss, condensed cash flow statement, condensed statement showing changes in equity, and notes to accounts, significant accounting policies and explanation statements, and along with that disclosures if any is also supposed to be made. So till now what we understood is what. The next question is who. We have to discuss each of this in detail, each of these statements how to prepare. We are not going to discuss complete set, we are going to discuss the condensed set. That will be discussed in how to prepare the condensed set. Yeah. So next question is who are supposed to prepare interim financial reporting. What are the entities for which this standard is applicable? So the first and foremost thing is Ind AS doesn't tell anyone to follow. Ind AS doesn't tell who should follow this. Ind AS doesn't tell anyone to follow this. So Ind AS will not compel. So who is it that will do? It is always SEBI. It's always SEBI, Securities Exchange Board of India, that pushes people to do this, or stock exchange. Now you might be wondering, so how does that tell? The answer is pretty simple. Who should basically be preparing interim financial reportings? All the listed entities. Listed entities are supposed to prepare their financial statements for a period lesser than a year also, and they are supposed to submit it to the stock exchange where they are listed, which is obligation under SEBI Act also, Securities Exchange Board of India Act. So Ind AS does not push you to prepare interim financial reporting. Yeah, it is SEBI or it is stock exchanges which pushes these people to do. So the next question is when? When should we prepare interim financial reporting? Is it after every week? Is it after every month? Is it after 2 months? Or is it after half year? Who tells this? Firstly, we need to remember that Ind AS doesn't tell when to prepare. Ind AS doesn't tell you when to prepare your interim financial reporting, but who tells it then? The answer is SEBI or stock exchange. What do? They can control listed entities. So listed entities to present financial statements quarterly. Yeah, quarterly they are supposed to submit their results. So you might be wondering, no, Q1, Q2, Q3, Q4. You might see a lot of changes happening in the stock market. Then if you ask why, they say Q4 results are out, Q3 results are out. You tell that. So that quarter results are supposed to be announced by each listed entity in the stock exchange in which it's listed. And that listed entity is supposed to give such information about their quarterly results to the SEBI. You get that? So this compulsion is again made by SEBI. You get that? So this is again usually the term for which interim financial reporting is made is quarterly. Next question is why? Yeah, why do we do this interim financial reporting? We understood what do you mean by financial reporting, interim financial reporting, who does it, when do they do it, but why do they do it? Now, we always prepare our financial statements annually, isn't it? As per Companies Act, we are forced to prepare it annually. So we prepare it, it is to say accepted by the board, and it is put across in the general meeting, made public, and then available to all the shareholders as well as all the prospective investors and everyone. So why should we do it quarterly? Why should we do it for a period lesser than a year? Because that leads to better understanding for of what? For better understanding of financial condition of the entity. And the next thing is liquidity of the entity. There is no better example than the current state what we are going through, or current situation that we are going through. Now we are done with April, May, June. So we are done with the first quarter basically. You get what I am trying to tell? So the first quarter is over. We are almost in the month of July, August now. Now every entity should release their Q1 results. Now this Q1 results would be very pathetic. We know, because the COVID has impacted, the pandemic has impacted the entire state of operations. So if we don't basically announce our results right now, and if we wait till March, we have the people in the market doesn't know whether the company has done well or not. There are certain companies which have done exceedingly well even during this pandemic. Parle-G has done amazing sales. Britannia has done really good sales. And then Radhakrishna Damani became multiple times richer. Our D-Mart group has done really well. So they've done well. So you cannot wait till the end of year to understand your financial position and performance. That might delay the decision. If you take the right decision late, it will no more be right decision. So the right decision should be taken at the right time. In order to take the right decision at the right time, the information should be available to me at the right time. Yeah, lot of our own clients are thinking of winding up their entire organization, entire business. Lot of those organizations which had like plans of setting up a new entity have put it on hold, saying that this is not the stage of the market at which I'm going to venture into a business. If their business is not very viable, the entertainment industry, the travel tourism industry, hospitality industry have taken a very bad hit. You get that? So the right decision is to be taken at the right time. In order to take right decision at the right time, information is required at the right time. So to provide the timely information, not at the end of the year, in advance. So what do? We need to prepare quarterly statements. So this is in order to help the financial conditioning as well as the understanding the liquidity of the organization, so that before you go really bad, you can take measures to face that liquidity crunch that your organization is going to face. So that's with respect to why. Now let us, what we're going to do right now is we're going to discuss the last question in the standard. How? Sir, so soon? Last question? Yeah, but this question is going to be long. We're going to discuss in detail how to prepare the condensed set, each of it, condensed balance sheet, condensed PL, condensed CFS, each of it. So this is going to be the long question. Yeah. So let's go ahead. So now we're trying to understand how to prepare interim financial reports. Okay. Whenever we talk about this, as I told you previously, what will we be preparing? We'll be preparing financial statements. Okay. What are the two modes in which these financial statements can be prepared for interim period? Two methods. Method number one is complete set. We can prepare complete set. The second one is condensed set. We can prepare a condensed set of this particular operations. Whenever we prepare complete set, what are we going to do? Okay, same thing as discussed in Ind AS 1. What does Ind AS 1 talk about? Presentation of financial statements. Sorry, preparation of financial statements and presentation. Yeah, we're done with that one. So we'd have to go back and see my video, session number 3 and session number 4. Yeah, so please do go back and watch it. The link, the link to such thing is in the description. Now, let us go to the next one, condensed set. When I spoke about condensed set, I had mentioned few things. So what and all are we going to prepare? We will prepare condensed balance sheet, condensed statement of profit or loss, condensed cash flow statements, then okay, I forgot one more here, condensed statement showing changes in equity. The triangle denotes changes, and then we need to prepare notes, significant accounting policy changes if there is any, then explanation statements if there is any, and we also need to make certain disclosures. So these are the, oh, I'll write it in black, that gives good view. It will look cute and beautiful. So these are the things. So let's get started. That is, we'll start with our condensed set now. So how to go about with condensed set? I'm not going to discuss about our complete set. Yeah, as I've told you many times, and I've written 2 times on the paper always saying that this is already what we've discussed in IAS 1. Yeah, when you go for condensed set, first and foremost point that I'm trying to discuss is line items. Yeah, with respect to line items, okay, headings and subtotals or totals also. Headings and totals, however it is there in the previous financial statement, same needs to be maintained. Okay, headings and totals, subtotals and totals in previous financial statements, whatever is there, to be maintained. Will not go for new subtotals, will not go for new headings or something. So we'll maintain the same headings what was maintained in the previous financial year. Assume we're in 2019-20, and I'm doing interim financial reporting for quarter 1 of 2019-20, that is April, May, June of 2019. So when I'm doing this for 18-19 financial year, I would have prepared balance sheet, I would have prepared PL, I would have prepared CFS. There would be certain headings, certain subtotals, certain totals. So the same headings will be maintained in the Q1 interim financial reporting for that is made for 1920. So previous year financial statements, whatever the headings are maintained, same headings will be maintained for this period also. However, you are allowed to have additional items. Additional line items are allowed. You can write a separate line. Additional items allowed if it is material. Additional items are allowed if it is material. So previously there were only 2 categories in a specific thing. Now can I write 3 categories? Yeah, allowed. In this interim financial reporting, can I write 3 items, whereas in the previous year financial statement there are only 2 items? Yes. So when is it allowed? When that particular additional item, whatever is going to be prepared, is material. Material means what? It affects the decision making. When will it affect the decision making? If I don't prepare that third line and include it within that second line only, then it might be little different. It might give a different understanding. So writing it here will lead to different understanding. Adding a third line will have different understanding. So then can I add the third line? The answer is yes. So if it is material, that is not adding additional line item is misleading. If I don't add that additional item, then that financial statements will lead to wrong decision making or different decision making of the user. So my objective is to upkeep materiality. You get that? So give all the facts and figures which are relevant for the decision making of the user of the financial instruments. So what is it that I should do? I should basically ensure that there is no misleading information. So I will give that additional line. You get that? So in the condensed set, what we are discussing, I am done with the first point. So the next thing that I will do is I will discuss each of them in detail. So shall we discuss? So the next point is with regard to period. What exactly should be the period for which your interim financial reporting is made? You get that? So this I am discussing in detail for each of the items. First one is with respect to condensed balance sheet, condensed statement of profit or loss, statement showing changes in equity, and cash flow statement. Condensed. So these are the items. So what is the period for which I need to prepare this? You get that? So the subheadings here will be, okay, I can write here how much of it will be prepared for current year and how will it be handled for previous year. So with regard to current year we can do it for IFR period. Now with respect to condensed balance sheet, it will be prepared for IFR period. Now assume the IFR period is April, May, June in the year 1920. So we can prepare balance sheet as on 30th of June possible. And condensed PL is also prepared, that is starting from April till June. So for that period. If it is quarter 2, July, August, September, balance sheet is prepared as on 30th of September 2019. And then condensed PL is prepared starting from July till September. So for those 3 months period, we will prepare PL. Whereas there would be nothing of that sort prepared for changes in equity and condensed CFS. Condensed CFS will not be prepared exclusively for IFR period. Condensed statement showing changes in equity will not be prepared for exclusively our IFR period. However, what do we do in the current year then? There is another option. Year till date. What do you mean by year till date? Year till date means from the beginning of the year till the date on which IFR period is ending. If it is Q1, quarter 1, that is April, May, June, then there is no difference between IFR period and year till date. IFR period is April to June. Year beginning is April, date is 30th June. So year till date and IFR period is same. However, if we take Q2, quarter 2, then our IFR period is July, August, September. Our year till date is April, May, June, July, August, September. IFR period will include only 3 months, that is quarter 2, July, August, September. Our year till date will start from April, end in September. So that will include 6 months. Balance sheet is prepared on a specific date. So it doesn't really matter whether the period is 6 months, 3 months or anything. So year till date concept won't exist. It is not year till date. Okay, fine, I'll say not applicable. Not applicable because it's a position statement. It is prepared as on a specific date, not for a specific period. I'll repeat. Balance sheet is prepared as on a specific date, not for a specific period. So you prepare it from April to September, from July to September, or only on September. Balance sheet will remain the same because on the heading also we write, isn't it, balance sheet as on a specific date. Whereas now talking about our condensed PL. With respect to condensed PL, when we do it for quarter 2, as on 30th of September, we prepare it, condensed profit or loss statement for July, August, September, 3 months. Also, along with that, we prepare from the year till date, that is July, August, September, 1 condensed PL, April to September, 1 PL. So, we would have to prepare this also. You get that? With respect to condensed PL, we will prepare it for that interim financial reporting period plus year till date also. With respect to statement showing changes in equity, we will not prepare for interim financial reporting period. We will prepare it for year till date. And condensed cash flow statement is also prepared for year till date. This is with respect to current year. I'll draw lines so that you are able to differentiate between what I'm trying to tell. So the current year you understood what and all is to be prepared. Now let me take it to previous year. Yeah. So with respect to previous year, why do we prepare it for previous year? Because it is comparative. So it is a comparative, to compare analysis, interpretation, communication. So analysis stage we compare it with the previous year to understand whether we are doing better than previous year, whether we are doing worse than previous year, or we are doing what. We need to understand that. So we prepare the comparative. So this comparative first one, previous year end. So where and all do we prepare it for? Previous year end. Balance sheet comparative is prepared to previous year end. Now assume that I am in quarter 1 end, April, May, June. 30th of June I prepare my balance sheet. Condensed balance sheet is as on 30th of June 2019. The comparative column will be balance sheet as on 31st of March 2019. So the previous year end, 31st of March. Whereas do we do something related to this in condensed PL? No. This one? No. So how do we bring in comparison for these items? For these items the comparison will be year till date in previous year. Now assume that we are preparing our Q2 ka results. Q2 IFR we are preparing, interim financial reporting. So Q2 will be, we would have prepared July, August, September ka interim financial reporting for balance sheet or for PL, and I would have done April to September also for 2019. So I'll do similar period, corresponding period in the previous year, that is April to September in 2018 will be my comparative. It will be my comparative for condensed PL, and it will be my comparative for my statement showing changes in equity as well as my condensed CFS. Do you get what I'm trying to tell? Sir, when will it be less? It will be less in Q1. It will be less in Q1. Why? In Q1, IFR period and year till date will become same. So these two columns under our current year will become one. And here previous year also there will be only one column. So that will become easier. I hope you understood. So this is how we do it. However, there's an important situation. If business is highly seasonal or uneven, like there is an entity which will have sales only in one part of the year. Maybe if you are dealing with crackers, if your business is related to crackers, you will have high sales during Deepavali or whatever the North Indians call as Diwali. Same thing. During the other parts of the year, if RCB is going to win the cup, we'll buy crackers and then celebrate. If not, no. So there would be no high sales of crackers. Or if there is any other entity, or maybe something related to Christmas, the sales will be very high only during the Christmas period. Or if it is related to, what to say, certain things which is related to Indian festivals and all, during the Shravan Masa, when there is high amount of festivals coming in, then there will be huge sales. If not, no. So if the business is such highly seasonal or uneven, then what do we do? Then IFR period will differ. Then the interim financial reporting period will be different. So what do we do then? 12 months ending on IFR. Now assume my interim financial reporting is to be made as on 30th of September. So what I will do is, I will not take year till date, April say September, no, 30th of September 2019. So I will start from 1st of October 2018. 1st of October 2018 to 30th of September 2019 will be the period for which I will prepare my, what is say, interim financial reporting. And comparative. Corresponding period in previous year. Whatever is the interim financial reporting in the current year, corresponding to those dates, we just change the year. We put the previous financial statements years. When we change that, that becomes our corresponding period, and that is the period for which the comparative will be prepared in previous year. So going ahead, I want to discuss this part of condensed PL a little in detail. Condensed PL, few important like additional points are to be discussed. So we'll take you to the next page. Concentrate with respect to condensed statement of profit or loss. So what are those additional points? Point number 1, basic and diluted EPS to be computed. So even for that interim period, we would have to discuss, or we would have to compute the basic EPS and diluted EPS. How to compute basic and diluted EPS we have discussed in the previous standard, the video just before this. Yeah, our session 33, 32 and 31. Please go watch it. Yeah, so that's what we need to do. So we need to compute it, and I told you there for discontinuing, continuing operations, we would have to compute it separately, and for current year, previous year separately, and so we will have interim period also. If interim may, we have one for the interim period, one for year to date, and one comparative, 3 columns if they are there. For under each of the 3 columns, if there is current year, if there is continuing operation, discontinuing, continuing, discontinuing, continuing, discontinuing, for each of those 3 continuing, discontinuing, that is 6 items, we would have to compute 6 basic EPS and 6 diluted EPS. You got what I'm trying to tell? So EPS computation is going to become very huge and very intensive there. Yeah, if you have not seen the video on EPS, you can go back and then watch computation of basic and diluted EPS. Session 31 and 32 basically deals with session 31 is basics, 32 is basic EPS, session 33 is basically our diluted EPS part. That's something that's very tricky, and that video has gone little long like this one. So that's one important point. Next is with respect to this uneven items. Okay, I'll show it to you. concentrate, assume I'm writing a traditional PL, so don't get annoyed, it is just okay, fine. So we'll have expenses here, revenues here. I hope this part is clear. When I talk about revenues, few of the revenues will be even, few of the revenues will be uneven, or I can also tell it occasional. Occasionally they come, they are not there every day. Similarly, expenses also can be categorized even and uneven or occasional expenses, and we arrive at profit. Now how do we deal with this? Now the first and foremost thing is even items, there is no problem. Even items, no problem. No problem, they are even throughout there. Example for even items is, example is rent, salary, all this. See, you pay rent every month, you pay salary every month. Revenue will be interest, revenues will be interest, you will receive interest periodically. Yeah, anything of this sort, wherein the revenue is also periodical and the expense is also periodical. It happens at regular time frames, you take it as and when it's happening, no problem. The interesting discussion starts with respect to this uneven or occasional items. So how do we deal with uneven or occasional items? So two categories. Okay, I'll write it like this only. Uneven costs or uneven expenses. Uneven expenses. Yeah, we need to consider them when incurred. Okay, I'll not use this color. You might be annoyed because that I've already used here. Okay. When incurred, we need to take them. As and when that expense is incurred, it should be taken, not when it is paid. It might be so that expense is incurred now but paid at a later stage. May it be, example, best example that I can give you is tax. Tax is paid at the end, or if you're paying advance tax, that's okay, different thing. If you don't pay advance tax, even if not, you pay that huge amount of sum at the end, isn't it? That in the quarter 4 only you might pay huge amount of taxes. When you pay that, is that huge amount paid expense of quarter 4? No. The profit is made in year 1, quarter 1, quarter 2, quarter 3 and quarter 4 also. So what we need to do is, we need to compute effective rate. We need to use effective rate computation, and tax expense should be split throughout the period. You get that? So we arrive at the effective rate of tax, and that effective rate we apply on the profits of each quarter, and then we take it. And sir, how do we estimate the profit? It is, to an extent, it is accounting estimate only. It is not like for sure. And depreciation, we will not do it at, see, we usually write it at the end of there, but the depreciation is because of the usage of the asset in year 1, year 2, year 3, sorry, quarter 1, quarter 2, quarter 3, quarter 4. So each of the quarters we need to write it. You get that? So effectively we identify the rate of depreciation and then we take it, and don't do it compounding effect. Yeah. So that's with respect to uneven expense. It is taken when it is incurred, not when it is paid. What do we do with respect to uneven revenue? We take these when they occur. When they occur, like, see, some part of the month there is some revenue, some part of the month there is no. Don't like try to anticipate it. No. Take it as and when such revenue actually happens to you. Actually it occurs. So no anticipation. No anticipation. With respect to uneven expense also, we don't anticipate, but few expenses are for sure. Tax has to be paid. Where will you run away? You get that? So, but revenue, your customer might go to someone else. He might not come to you. So you get that? So in uneven revenue, no anticipation. Whereas with respect to expense, no anticipation. But if you are sure, you need to record it when it is incurred, not when it is paid. You get that? Example can be dividend. I am not talking about dividend expense, I am talking about dividend income. Like, I have invested in certain shares, I am a parent, I have subsidiary, or I am an investor in some company, and that company has to give me dividend. They will give dividend, interim dividend is there. If I am talking about final dividend, that comes only after AGM. You get that? So that AGM will be declared in Q4 or next year Q1 or something. So should I anticipate it previously and then write it in Q1, Q2, Q3? No. Dividend right to receive is established only then it is recognized. We'll talk about this when we come to Ind AS 115 also, revenue recognition. So what I'm trying to tell you is, and it will be discussed in financial instruments as well. So when we talk about dividend, dividend is an income when we have right to receive. A right to receive is established when there is a declaration. Declaration is made in Q4 or Q1 of next year. Only then we'll record it. We'll not record it right now. You get that? We'll not anticipate that income. To be very frank, no, this is against our conservatism also. So I'll write here, concentrate. By conservatism, or another word, prudence. What do we mean by conservatism or prudence? Conservatism or prudence means that account for all expected expenses and losses, but not for expected incomes and gains. If you expect an expense, record it. If you expect an income, wait till it actually happens. So that's with respect to uneven expenses and uneven revenues. I can give you one more example. Other than dividend, you can take government grant also as what is an example. So if I go back, in interim financial reporting period, we've done with balance sheet, PL, statement showing changes in equity as well as CFS. Is that all? No. We need to discuss few more things. No, in the condensed set, we discussed few major points. We're done with condensed balance sheet, PL, statement showing changes in equity, CFS. We have not done with these two. What to say? Note significant accounting policies and explanatory statements along with disclosures. So that's our next point of discussion. So we discussed 1, 2, let us now write 3. That is 3. Come on, let us write that. 3. What is 3? Notes, significant accounting policies, explanatory statements. Yeah. So under this, the first thing that I want to discuss, or the first point that I want to discuss, is accounting policies. Yeah. What exactly do you mean accounting policies? It is principles of recognizing asset, liability, revenue, expense, etc. So what are the principles that we're following in recognizing the asset? What are the principles that we're following in liability recognition, revenue recognition, expense recognition? With that, when there is more than one way, all of them being correct, the rules, conventions, basis. Remember session 1 discussion. So that thing. So that what we followed is our accounting policies. And these accounting policies are supposed to be consistent. What are they supposed to be? Consistent. To be consistent. To be consistent from previous reporting period or previous financial, I'll write as previous financial year. Yeah, previous financial year mein whatever we have followed, the same accounting policies are to be followed in the current interim period also. However, there is an exception. However, if there is change in accounting policy, there is change in accounting policy in the year to which IFR pertains, then accounting policy can be changed. I'll repeat. In the previous year, assume that I am preparing interim financial reporting for quarter 2 of 1920. Quarter 2 of 1920. Whatever the accounting policies were followed in 1819, same should be followed. When can I change it? Assume, I've assumed for whatever reason, Ind AS has changed, or what you say, the law has changed, or for the purpose of better presentation, I am going to change my accounting policy in the year 1920. 1920, 1st of April, I have initiated the change in the accounting policy. Then, for quarter 2, should I follow the same accounting policies followed in the previous year? No. Such changed accounting policy, what is implemented in the current year beginning, that can be followed. Now, if I do that, the previous year comparative what I am preparing will have a different accounting policy. The current year IFR period will have a different accounting policy. Then it is not comparable, isn't it? I'll repeat. In the current year, we've changed the accounting policy. When we've changed the accounting policy in the current year, IFR period in the current year will have a different accounting policy. The corresponding or a comparative IFR that is prepared from the previous year, that comparative column or whatever is there, that will have a different accounting policy. So they are not comparable anymore. So what do we do? Same thing, what we have discussed in Ind AS 8. Remember? Ind AS 8. So what do we do? change in accounting policy, retrospective effect. What would we should be giving? We should be giving retrospective effect. When we talk about retrospective effect, what and all will change? I'll tell you. Number one, prior interim period in current year. In the current year, quarter 2 I am no, and if there is a change in the accounting policy in the current year, that quarter 1 ka we would have prepared IFR, there also there should be the new accounting policy. We should redraft it, we should retrospectively change it, and corresponding period which is taken as comparative from the previous financial statement, that also should be redrafted. That is comparative from previous year. So both of them should be changed. I'll write here revised. For what? Change in accounting policy, would have to revise them. However, there is an exception. Ouch, that should have been black. However, there is an exception. What is that exception? Shall I write it? If impractical, if it is not practically possible, then note this, prospective change. For whatever reason, if the management feels that for this interim period redrafting the previous year is impractical, not at all possible, maybe in this scenario only, so you've lost your employees and your organization is about to shut up, going concern itself is questioned, and maybe because of the requirement of the stock exchange you have to prepare, but you don't have enough data, server is hanged or something has happened wherein you cannot redraft your previous year financial statements, that corresponding period, then what do we do? Okay, prospective, for the current year this quarter you will follow the new accounting policy, the previous year that will be there. Can you be quiet? No, we have to disclose. We have to disclose, saying that there is a change in the accounting policy in the current period. We have followed this, but in the previous period there is a different accounting policy followed, but we are not able to change it retrospectively as required by the Ind AS. We have changed it prospectively, meaning the current interim financial reporting period data is in, or they say that this accounting policy, the corresponding or the comparative is in there in different accounting policy. We would have to disclose this. So this is our entire discussion with respect to which one? Accounting policies. So next I would have to discuss little with respect to accounting estimate. Let's discuss accounting estimates. Yeah, whenever there is change in accounting estimate, we will be giving it prospective effect, meaning if there is change in that accounting estimate in quarter 2, we will change it only in quarter 2. Quarter 1 it will remain the same. If there is change in that accounting estimate in quarter 3, it will be changed only in quarter 3. We are not going to go back in time to change that previous quarter's details. So change in accounting estimate, always what effect? Prospective effect. Now you might be wondering, sir, this is simple, why are you discussing this? I will tell you. This opens for a very interesting discussion. Now assume that you are preparing financial statements, interim financial statements for quarter 4, that is January, February, March, last quarter in the year, and there is one accounting estimate which has changed. So what you do, you give that prospective effect in January, February, March, and you might be preparing interim financial reporting year till date. Year till date is what is the beginning of the year till the end of interim financial reporting period. If you prepare interim financial reporting for quarter 4, year till date and the entire year will be same. I'll repeat. If you are preparing IFR for quarter 4, then year till date and entire year will be same. Year till date will become April to March, and then financial year is also April to March. So you might decide not to prepare separate set of financial statements. So your Q4 results, your Q4 wala report as well as your annual statements are same. You might decide so. It's not in all the cases. You might decide so. If you do that, then the change in accounting estimate is not disclosed anywhere, isn't it? It is just getting wiped away. So what do we do? Then we need to make separate disclosure if it is material. If it is material. I'll write that point, okay? If there is change in accounting estimate in last interim financial reporting period and entity doesn't prepare separate financial statements for annual, then what do we do? Yeah, check materiality and disclose such change in accounting estimate. See, if such a change in accounting estimate is very small, very negligible, then okay, cool, no problem. If it is not very small, if it is something which is material, which might affect the decision of the user of financial instruments, not disclosing which is misleading, then what do we do? Then we have to disclose it. So I'll write it for you here. When I tell about last financial interim reporting period, I mean it is a Q4. You get that? That is with respect to accounting estimate. So then we're done with this also. Then I have to tell you the last part, that is with respect to the disclosure things. So if I pick the green, this is also done. So now we'll discuss the last part, that is our disclosure. Come on, let us go for the last part. 4. Disclosures. So what are the disclosures that are supposed to be made? This is with respect to transactions and events. It is with respect to transactions and events which are significant. It is not significant, no disclosure required. And the next thing is material. So two tests. It should be significant, it should be material. If it is significant and if it is material, that is, it is not like something that will happen in a general sense, then it needs separate disclosure. So what are these items? Something maybe like a prior period item. What do you mean by prior period item? An error that is made in the previous year, but you identified it this year, so it is rectified this year, so it will impact current year profit. So an item arising in the current period because of an error or omission in the previous period is prior period item. I repeat, an item appearing in the current year because of an error or omission in the previous period, that is prior period item. If there is such prior period item, it needs to be disclosed. Or something like acquisition or disposal. These are not usual, no? Acquisition and disposal of not goods, of property, plant and equipment. And with respect to this, if they have taken any loan and there is breach of loan agreement, or if there is any litigation arising against these items or against the entity as a whole, yeah, or if there is any not normal item like impairment loss or reversal of impairment loss. Impairment we're going to discuss in the next video, that is Ind AS 36. So we'll discuss it there. So if there is any impairment loss or any reversal of impairment loss, then such an item has to be disclosed. And other than this, there are few other disclosures also. However, note this, I'm going to discuss this impairment and reversal little in detail. So we have to discuss it. I'll discuss that after I tell you few other points. Something like changes in accounting policy. Yeah, we've already discussed a little of it previously. So something like that, if there is any changes in accounting policy, it's need to be disclosed. If there is any subsequent events. What do you mean by subsequent events? Subsequent events are events that are happening after that interim financial reporting period, but before those are given out. If there is any events that are happening or after the previous IFR period and current IFR period, if there is any events happening, such events are supposed to be basically disclosed. And if there is any uneven, or what do you say, something like seasonal or cyclical items. If it is seasonal business, then what is the policy that we have adopted? Policy adopted with respect to treatment of such things, that is supposed to be disclosed. On the left, whatever I wrote is basically our transactions, and the right is our events, something of that sort. Yeah, you get that. So I told you that we need to discuss this part a little in detail, impairment loss and reversal. Now this impairment loss, what I am trying to discuss in detail, is not with respect to impairment loss in all the assets. This specifically with respect to goodwill. impairment of goodwill. That is an intangible asset. We'll discuss this in detail in our next standard, but right now little discussion. Okay, if there is any impairment of goodwill, it needs to be checked. However, it's okay to be checked at every reporting period. Now if at end of every reporting period we would have to check for impairment of goodwill. Now assume Q1 is over and at the end of Q1 I checked for impairment of goodwill. There is impairment. I have recognized that impairment loss, and impairment is recognized based on the conditions. Certain things are going value in use, recoverable amount, present value of the future cash flows, everything is considered. What has happened is Q1 I have recognized impairment loss. Now I go to Q2. When I go to Q2, the conditions have changed. Which has either decreased the impairment loss or nullified the impairment loss. Now as at the end of Q2, it has nullified the Q1 impairment loss. There is actually no such impairment is what I feel now. Should I reverse it? The answer is no. Impairment loss once recognized, if it changes because of changing conditions, then such reversal should not be made. You get that? I'll write it. IFR. Next IFR. So here we have impairment loss. Loss is recognized. What happens here? Impairment loss is reduced. For why is it reduced? For change in conditions. What should we do? We should be not doing any reversal. No reversal of impairment loss recognized in prior to interim financial reporting period. Previous to our current interim financial reporting period, if there is any impairment loss recognized which has been changed now, which has reduced or become zero because of changing conditions, we will not be reversing that impairment loss anymore. This is exclusively with respect to goodwill, guys. It is not like with respect to every other asset. This is exclusively with respect to goodwill. That's a very notable point. And by this, if I take you back here, I am done with disclosure as well. So we're done with entire thing here. So we're done with the condensed set. And complete set, I told you Ind AS 1 we've already finished in session 3 and session 4. Session 3 and session 4 of our Ind AS revision. You can check the description. I've given the link to all the videos in the description. You can find it there. Go back and watch it. So that's with respect to interim financial reporting. I could have split it into 2 videos, but I somehow felt like doing it in one shot, one video. I didn't expect it to go so long, however. So that's with respect to interim financial reporting under Ind AS 34. See you all in the next one with another different standard. Till then, stay in the game.